Welcome to Technical Tuesday. This is Federated X, unit trading strategist here at CMTrading, and we're continuing our reversal pattern series. And today we're going to break down saucers and V patterns, otherwise known as spikes. But before we start, make sure to like, subscribe, and do share, especially if you find value in this presentation. All right, so this is the thing. This is reversal patterns. Reversal patterns generally are coming at an extreme. And these two are probably the most extreme ones, okay? Meaning to say that they're complete opposites, okay? Saucers usually take a longer time to develop. It's really hard to see them actually developing as they're happening. A V pattern happens very quickly. It's very aggressive. And it's also very hard to predict as it's happening. But there's always that element of it's happening and you're seeing it's happening and you're kind of almost anticipating the reversal pattern to it. All right, so let's just break it down and see what they look like and we'll speak about them. All right, so this is a saucer. It's usually at a bottom, okay? And this part is what we call the saucer. It's really the part that's consolidating. It edges down, okay? And then it has an extreme breakout. And once that breakout is confirmed, it continues. Now, as everything in technical trading, as we've spoken to about before, the two most important elements are volume and time. So the longer this time period, the more significant this breakout will be. Again, the longer this time period will be, the more significant this breakout will be. It doesn't mean that it's going to be an extreme breakout, but it's going to be that it's going to have a breakout that's very significant, all right? So that's really important. Now, in this particular pattern, it also sets itself up to have a neckline, to have an area of resistance, and then subsequent support in order for it to break out, all right? Those are two very important elements when you're coming to looking at a saucer. It does happen quite often, and recently we saw it on a couple of symbols in the market, including gold, including JP Morgan. It also happened with, so it does happen often. And when that extreme move happens on the upside, it's really a great opportunity to jump into it. All right, now the next one is what we call a V pattern or a spike. Now, generally speaking, they happen very quickly and very aggressively. The only thing is that when you're caught in one of these, okay, either, you're in a position and it's going against you, I hope that you don't find yourselves too much in these type of positions because they're really extreme and a lot of people just get fed up with it. You don't want to be in a position before this V pattern actually happen. You want to be in it after it's confirmed that it's going up above and breaking. Now, in similarity to the saucer, the V pattern also does have a neckline. Okay, this particular one does. And it's not this exact pattern, right? This is a variation of it. And they do come out with different variations. Some even have a gap up or a gap down, and then an exhaustive move. Usually, V patterns happen at an extreme move, at an end of a moon, and that's why it's a reversal pattern. Now, there's tremendous amount of volume at the peak, and subsequently, once it retraces and then breaks out, this subsequent volume is less, okay? So time and volume are two of the most important components here as well, where you want to see how quick that V pattern is developing itself, because that counter move will be just as quick as well, all right? Whereas with the saucer, it takes a longer time for it to actually develop, okay? This happens almost instantaneously, okay? Now, a common time frame for this is probably a daily, okay, or maybe a weekly, whereas in the saucer, you're looking at a monthly and possibly as a weekly as an indicator there, and sometimes even a daily, okay? But however, just keep it in mind that the longer the time frame and the volume that confirms it, the pattern is then confirmed. But it's a huge opportunity. I can't tell you, some of the biggest trades I've made are actually in V pattern kind of opportunities because they are so aggressive and they're so volatile that even if you're not trading big, you could actually size down on your trade okay? Not trade, let's say you have a $5,000 account, trade only $4,000 of it, $3,000 of it, okay? You're trading a good portion of it, but you're not putting everything into it. You could even slice it down to maybe 1,000 points of it, okay? Because it's so aggressive. And so keep that in mind. These type of opportunities are much more aggressive. There's an old Chinese proverb that says, with greater risk, there's greater profit. But we also want to minimize the greater risk to it and greater loss, okay? So keep that in mind when you're trading these two type of patterns. They're really very useful. They happen very often in the markets, and they're an added addition, tool, and weapon to trading the financial markets. Thank you for joining me for this Technical Tuesday. We'll see you here next week.